We're looking at a high-stakes portfolio audit. On one side, the hunt for the next world-changing technology. On the other, Warren Buffett's two oldest rules of investing: never lose money and never forget rule number one. The 2026 macroeconomic landscape marks a shift away from digital software. Today, capital is now moving into the physical and biological engineering required to sustain the artificial intelligence era. This creates the barbell moonshot dilemma. The goal is to capture 10x upside in emerging tech without allowing binary risks and trading churn to destroy the underlying capital. Profiting from revolutionary inventions like neuroplasticity meds or photonic chips requires a robotic, emotionless execution strategy. This approach is rarely intuitive for the retail investor. Investors are now forced into two roles. You must act as a venture capitalist when evaluating the upside, while maintaining the discipline of a value investor to protect the downside. Choke point assets of the future offer immense rewards, but only for those who can navigate the structural traps of high beta investing. To see these traps in action, we're running a forensic audit on a real-world portfolio. This account is built on high-conviction thematic bets. This is textbook extreme concentration. 18.6% of the account is focused on a single clinical stage biotech, Hellas Pharma. The rest follows suit. AI, synthetic biology, takes 14.6%, and photonics sits at 5.7%. It's effectively a venture substitute strategy. Moving from stock selection to the cost of doing business, we have to look at the staggering drag of trading fees on this specific account. In a single year, costs and charges had a 30.85% total effect on the account's returns. Commissions alone consumed 17.53% of capital. This is the churn trap. Frequently trading volatile microcaps leads to catastrophic losses through wide spreads and platform fees. A strong technology thesis means very little if execution costs consume nearly a third of the annual capital. The first major alpha leak is a heavy overweight in semiconductor hardware. This 17% allocation to an AI infrastructure ETF is dominated by familiar chip giants. The power bottleneck thesis suggests that electricity, grid permitting, and transformers are now the absolute binding constraints for AI growth. While the chip market is saturated, the physical infrastructure layer remains the essential, uncrowded alternative. Institutional filings confirm this rotation. Recent data shows a $14 billion fund deploying $7.7 billion into semiconductor puts, while going long on power infrastructure and fuel cell technology. This makes photonics efficiency assets a vital hedge. Technologies like POET alleviate the power wall by reducing the electrical load required for data center interconnects. The 2026 rotation favors moving away from chip hype toward the power choke points required to sustain the network. In biotech, the stakes are tied to revolutionary inventions like psychedelic neuroplasticity meds or AI-designed antibodies. These companies live or die by the binary event, a single phase 3 readout that determines if valuation multiplies or evaporates. Even a clinical success can trigger a drawdown. Prices frequently drop 30 to 50% immediately after positive data, as early investors take profit and the company issues new shares. Hellas Pharma's recent $50 million raise is a primary example. Positive clinical momentum was immediately used to dilute shareholders to fund future trials. Evaluating these companies requires a reinvention score, measuring their potential to obsolete legacy psychiatry or drug R&D models entirely. Biotech offers high torque, but it demands strict position sizing to survive the post-event volatility. Warren Buffett's principles provide a cold reality check for the disruptor hunter. Speculative asymmetric bets often lack the durable moat and margin of safety required for long-term compounding. Behavioral fatigue often causes more damage than a technological failure. Constantly realizing short-term losses and paying taxes out of emotional panic creates a churn that dismantles the capital base. Even a highly rated strategy requires tighter cash management. Without it, the portfolio risks blowing up on a single binary clinical miss. The roadmap for 2026 is the barbell architecture, a strategy that balances protection with extreme upside. 50 to 60% of capital stays in the foundation, anchored by structural ETFs tracking the S&P 500 and AI infrastructure. The remaining capital forms the venture tail, but with a strict cap of 3 to 5% per ticker. This structure protects the downside while leaving the moonshot upside fully intact. High-frequency trading must be replaced by thesis-based exit rules. You only sell when the fundamental technology thesis breaks, not because the market is volatile. This architecture transforms a speculative book into a professional technology fund. To win in deep tech, you must be a visionary on the assets, but a machine on the execution. Anchor your foundation, cap your moonshots, and stop the churn. That is the only way to hunt for life-changing inventions without going broke.